Throughout 2025, Bitcoin lending platforms have exploded in popularity, giving Bitcoin holders a way to access liquidity without selling their Bitcoin. But is borrowing against your Bitcoin a smart financial move? Or is this a ticking time bomb? In this video, we are going to break down exactly how Bitcoin borrowing works, the trade offs, the math, and the risk factors you need to understand. And at the end of this video, I will show you a brand new product that lets you do this safely while also potentially reducing your tax bill to zero. All right, so to understand whether or not it is a good idea for you to borrow against your Bitcoin, you first need to understand that there are two types of debt. There's good debt and there's bad debt. And many people, especially those indoctrinated into the Dave Ramsey School of Finance, are only familiar with bad debt. Bad debt is when you have no assets or no collateral to support that debt. For example, if you have no cash in your checking or savings account and you open up a credit card and go on a trip to Disney World and rack up $10,000 worth of debt on your trip simply consuming goods, and you have no assets, no collateral to back that up. You're just spending money you don't have. That's a form of bad debt. Another form of bad debt is, and this has become cliche in 2025 to talk about, are college loans. You have no guarantee of income or a job after you finish your schooling. Moreover, you're taking on hundreds of thousands of dollars worth of debt and you have no assets and no collateral to back that up. It's also unforgivable. So these are two forms of bad debt. Now, good debt is entirely different. Good debt is when you do have assets and you do have collateral to back that up. And moreover, it's when you take the borrowed funds and buy more assets. Let's explain how this works. All right, so let's use a simple example to elaborate on a good debt. Let's say you have a house. Got your house here, and let's say this house is worth $1 million. Now, this may not look like $1 million house, but go with me. This is $1 million house. And you don't live in this house. This is just property you inherited. You live somewhere else. This is purely an asset for generating cash flow and preserving wealth. You're not using this as your primary shelter because that's very important here. Now, you have this $1 million house, and you go to the bank and you say, I want some money. I have this house. I don't have any cash. What can you do for me? So the bank, they're going to lend you some fiat. Now, this fiat, what's interesting about these dollars is the bank actually doesn't have them in the bank. They type up on their keyboard and create new units of currency out of thin air. This is how fractional reserve banking works. They're able to lend more units of currency than they actually have at the bank. And so this is inflationary. Now, on a minor scale like this, them lending you money doesn't affect the economy too much, but you can imagine as we extrapolate this out across all of the borrowers in the economy, there's a lot of currency debasement going on simply by means of borrowing. So the bank is smart. They're not going to lend you $1 million for your $1 million house. They might, but what they want is they want a lot of assurance that they're going to be paid back. So they're going to lend you $500,000. Now, this is great for the bank because you post your $1 million house as collateral. So if for whatever reason you don't pay this $500,000 back to the bank, they can repo your house, sell it on the market, and then pay themselves back with the proceeds. But you're smart. You're not going to not pay back the bank. So what you do is you take this $500,000 and you're pretty good at financial markets. You're in the weeds 24/7. You know what's going on. And so you take this $500,000, which the bank lent to you at, let's, for simplicity's sake, let's say 10%. They lent this 500K to you at 10%. So every year they're going to add, assuming you don't pay back the principal, they're going to add $50,000 to the loan. 500K, 10%. So this right here, this is your hurdle rate. If you can invest this in something, anything that will get you more than 50K per year, you're in the clear because you can pay off the interest, the principal stays the same, you're gravy. So let's say you take your 500K and you're really smart and you know what you're doing, you're an investor. You take this 500K and you buy a stock. It doesn't matter what stock it is. And that stock goes up plus 20% over the next 12 months. You got a heater, you knew what stock to pick, you did great, 20%. So your 500K becomes 600K. And then you take 50K and you pay off the interest. So your surplus at the end of the year, you now have $550,000 worth of stock XYZ, and your outstanding loan is 500K. This is great. You won. Now, it's not always that easy, right? Not everybody can just pick a winner out of a hat, 20% CAGR every year, or can you? Wink, wink. Stay to the end of this video and we'll break down some more of the numbers. But that's not the only wealth creation factor here because you could have taken 500K cash and just bought stocks, right? Why did you have to borrow to do this? What's the advantage of that? Well, the advantage of that is because you have so many people doing this at scale across the economy that now your house isn't worth $1 million. It's worth $1.1 million. So not only did you generate a positive return on your investment with the borrowed funds, the value of your collateral increased as well. And that's what makes debt very, very interesting and appealing. And that's where we can classify this as good debt. So, with that out of the way, let's apply this to Bitcoin. All right, so on the whiteboard now, I have a very simple borrowing against your Bitcoin example laid out here. You've got 10 Bitcoin. Bitcoin is at $100,000 per coin right now. So your 10 Bitcoin are worth $1 million. And you want to borrow against your Bitcoin. You want to be a wealth professional. You want to be like the rich. You want to build wealth using debt. So what do? You borrow against your Bitcoin. And here are your terms, for example, keeping things very, very simple. A 50% LTV. So you're borrowing $500,000, 500K, because you want the value of your collateral to be worth twice as much as the amount of money you're borrowing. And let's say it's a 1 year loan, 10% interest rate. So again, like our last scenario, you're going to have 50K in interest that will accrue over the next 12 months, assuming you do not pay this loan down. Now, what makes borrowing against Bitcoin much different than our previous example is, of course, Bitcoin's volatility. The price of Bitcoin can change drastically. Granted, volatility is down significantly since the ETFs were created, but Bitcoin far more volatile than the house from the previous example. So let's imagine worst case scenario. This is nightmare fuel. You don't want to be in this position. You borrow against your Bitcoin. You take out this 500K and you're a smart investor and you buy more Bitcoin because that's what I would do. Maybe. You take this and you buy some more Bitcoin. You get 5 more Bitcoin because like the previous example where you borrow and buy another asset to outperform your hurdle rate, you think Bitcoin's going up. You think Bitcoin is going to go up more than 10% next year, plus greater than 10%. But let's say it doesn't happen. Something unforeseen happens in the market. We're all wrong. I think Bitcoin's going up in 2026, and I would be probably pretty comfortable with this trade, but none of us are psychic. None of us can predict the future. So let's say we have this nasty bear market in 2026. Well, boom, Bitcoin went from 100K, now it's down to 75K. Now it's down to 50K. What happens at 50K? The value of your collateral is now worth the same amount as your loan. So what do? They liquidate you. You have to sell your Bitcoin. You lose it all. You don't have 10 Bitcoin anymore. You have 0 Bitcoin. Actually, you've got 5 Bitcoin that you bought, but you lost half your Bitcoin. So not an ideal scenario. But how can you protect yourself against this? Because again, this is worst case scenario. I don't think this is going to happen. I think 2026 is going to be bullish, but as a prudent investor, you want to position yourself to survive all scenarios. You want to weather the storm, build your house on the rock. So, what's an alternative? Because this will work great in a bull market. If Bitcoin goes up more than 10%, you're going to crush it. The value of your investment is going to go up, your collateral is going to go up. Boom, bingo. We want that. But how can you protect yourself if that doesn't happen? I'm going to show you right now. All right, so here we have the same basic framework. We've got 10 Bitcoin at 100K each, $1 million worth of Bitcoin, same loan terms, 50% LTV, 1 year loan, 10% interest rate. But instead of buying Bitcoin directly, you're going to buy some Bitcoin miners. Now, they're going to look better than my poorly drawn Bitcoin miners here, but this gives you an advantageous position to buying Bitcoin directly in a few different ways, and allow me to explain. So, with the miners, you're not solely betting on the price of Bitcoin going up. You're going to do very well with Bitcoin mining if the price of Bitcoin goes up, of course. And in this scenario, Bitcoin goes up, your collateral goes up, your profit margins from mining go up. That is fantastic. You're going to crush it. But you get two benefits that you don't get just buying Bitcoin directly. Because buying Bitcoin directly, you'll do well in a bull market. Mining, you'll do well in a bull market. But where mining can stand out is during a sideways or even down market. So as it stands, Bitcoin miners, especially those hosted with Blockware using the next generation miners, they're effectively able to produce Bitcoin at $60,000 per coin. So you have profit margins that are very, very lucrative. You're able to produce Bitcoin at 60K a coin. It's currently 100K a coin. That's fantastic. So what this does is it gives you Bitcoin cash flow. You're cash flowing in Bitcoin. So when the price of Bitcoin goes up, your cash flows expand, right? You're producing at 60K, Bitcoin goes from 100 to 150. Your arbitrage window there expands greatly. But what also happens is in a year very much like 2025, Bitcoin goes sideways. It's staying at 100K. It's not doing what any of us thought it would do. I don't know anybody who predicted this. I myself was wrong. I expected Bitcoin to be much higher at the end of the year. Alas, we were wrong. None of us are psychic. So Bitcoin going sideways, you're continuously every day acquiring more and more Bitcoin. And so what this does is it allows you to cover this 10% interest rate, this hurdle rate, even if Bitcoin doesn't perform the way you want it to, while also not sacrificing that exposure to Bitcoin's upside. For example, when you just bought Bitcoin with the loan proceeds, Bitcoin goes flat on the year, but you owe 10%, you actually lost out on that trade, right? Because you accrued 10% worth of interest. Bitcoin didn't beat that 10% rate. And so you made out worse than if you wouldn't have done the play at all. But with mining, you're able to generate consistently 30 to 50% annualized returns on your capital. So let's say you take this 50% LTV, 5 BTC worth 500K, and let's be very conservative. You get a 30% ROI on your capital. So that would be $150,000 net return for the year. Now, it's going to be slightly more than that, and I will get back to that later, but let's be very simple. 150K, so you more than beat that 10% hurdle rate, right? Your loan accrued 50K in interest, but you earned $150,000 from operating your miners. Bang. $100,000 surplus, and you still have the miners to boot. So this is great, but then imagine it during a bull market scenario, right? And then instead of earning a 30% return, you earn a 100% return. So your 500K deployment into miners nets you 500K worth of Bitcoin minus the 50K you're going to accrue in interest, 450K surplus. Now, there's another key benefit to Bitcoin mining that many people don't know about, and it's this is tax deductible. 100% bonus depreciation. You can purchase $500,000 of Bitcoin miners and you can write off $500,000 of income in a single year. So if your business earned 500K in net profits, write it all off. You pay zero in taxes. This is a real strategy. This isn't a gimmick. You're not going to get arrested by the IRS. This is legitimate. And Blockware helps investors run this play every single day. You could be next, but that's not all. I'll get back to it. Now, imagine this. Imagine instead of 1 year loan, you could expand that out a little bit because, like 2025, none of us foresaw Bitcoin trading sideways. Anything can happen within a 12-month window. Nothing is certain. And so, One of the strategic advantages of debt is being able to borrow for longer periods of time. Because this does two things. One, it allows fiat currency to debase more and more, right? Inflation compounds on itself. 7% inflation from year one compounds with 7% inflation year two. And so the longer you can borrow your fiat currency, the longer you have to pay it back, the more it's going to debase and become less burdensome in real terms. Additionally, it gives you more certainty that your collateral, your Bitcoin, is going to increase in value. Because, fun fact, Bitcoin has never had two consecutive down years in its entire history. So you can really de risk your Bitcoin loan by borrowing on as lengthy of terms as possible. Remember when I mentioned earlier that it would be nice if we could just pick an asset and know that it's going to continuously compound over time at an attractive rate? Well, that's precisely what Bitcoin has done. Bitcoin's 4 year compounded annual growth rate is 11%. And this is actually on the lower bound, almost the all time low for Bitcoin. Typically, it's averaged between 20 and 50%. And Michael Saylor himself believes that Bitcoin will compound at 30% per year for the next 20 years. And I tend to agree with this hypothesis. And I would even go as low as, say, 20%, because even in that scenario, Bitcoin is still going to perform exceedingly well and will be worth multiple millions of dollars per coin in the next 2 decades. Do you think Bitcoin will be in the millions by 2045? I certainly do. And so, if you can borrow at longer terms, you're going to expose yourself to far less risk than if you simply borrow on 1 year terms. So, with that all said, let's get into action items. How can you actually apply this knowledge? Tax shield. This is the answer you've been looking for. Blockware is proud to announce this collaborative product with Arch Lending and Mark Moss. Arch is the top Bitcoin lender in the business. They allow you to borrow Bitcoin on terms up to 2 years with very competitive interest rates. Moreover, they only work with qualified custodians and they have all of the financial regulatory licenses in place. They are the most trusted Bitcoin lender in the market right now, and we're excited to bring you Tax Shield in collaboration with them and with Mark Moss, an advisor to both businesses. So here's how this works. Arch, like I mentioned, Bitcoin lender. You take your Bitcoin, you go to Arch, you get a loan because you don't want to sell your Bitcoin and have to pay capital gains taxes, but you want to access some of that liquidity and run this play I just showed you. So you take your 10 Bitcoin from Arch, you borrow 5 Bitcoin, and you take the 5 Bitcoin and you get exclusive pricing on Bitcoin miners from Blockware. So Blockware and our mining as a service enables you to mine Bitcoin without doing any of the legwork yourself. You don't have to build your own data center. You don't have to source your own machines. You don't have to find low cost power. You don't have to do any of that day-to-day maintenance, none of it. We handle all of it. All you do is enjoy the tax benefits, enjoy the Bitcoin accumulation, and watch your wealth grow. And our CapEx light model makes it so that you have a better Bitcoin cost of production than many of the top public Bitcoin miners. How does this work? Well, it's very simple. Large scale Bitcoin miners have to pay for all of the infrastructure. They have to pay all of their employees to manage the site. They have a lot of additional overhead from SG&A, from corporate executive salaries, et cetera, maintenance, all sorts of things. You, as a Blockware client, you pay for two things. You pay upfront for the price of the miners, and on a monthly basis, you pay for your power. You have one capital expense and you have one operating expense. And this lowers your Bitcoin break even cost, increases your profit margins. And the main benefit, like I said, 100% bonus depreciation. So not only are you accessing your liquidity without taking a tax hit, not only are you earning a 30 to 50% return every year with the Bitcoin miners with the possibility of much higher returns during a Bitcoin bull market, you're getting a 100% tax write-off on those miners. Now, if you are building your own facility, you don't get 100% bonus depreciation on transformers and containers to house the miners. But because your only capital expense with Blockware is the miner itself, entirely deductible, Consult with your accountant or financial advisor. This is not official tax or financial advice, but we've got lots of great content on 100% bonus depreciation. You can find it on the Blockware YouTube channel or go to blockwaresolutions.com and click through our resources tab and you'll find it there. So if you're interested in running this play, go to blockwaresolutions.com/tax shield. Again, you can borrow against your Bitcoin and build wealth with good debt like the wealth that you have done for decades. You get to ride the wave of fiat debasement while also increasing your Bitcoin stack and lowering your tax bill. Blockwaresolutions.com/tax shield. Blockwaresolutions.com/tax shield. Make sure to like this video, share it with a friend, leave a comment down below, and subscribe to the channel. Thank you for watching.